So, our fourth point of discussion will be our loans and interest. And this is quite an easy one and a straightforward one. I want us to remember when we were dealing with the issue of shares, we mentioned that companies fund their operations through either issuing shares or taking out loans with banks in order to fund their operations. So, interest when loans are concerned will be calculated in one of two different ways. It's either we will have a simple interest, which is calculated on the original amount. You might recognize this formula from your maths there. And then the second one would be our compound interest. And then this one is calculated on the balance of the loan. So this one is not calculated on the original amount, it's calculated on the balance. By what we mean by the balance is that we take the original amount, we add any accumulated interest we have to date, and then deduct any payments that we've made, and then that balance will be where we are calculating that amount from, right? And then another thing that is important with interest is that it must be apportioned for the number of months in the year. So if you only had this loan for 10 months, it means that your interest must be calculated for 10 over 12 months, right? So let us make an example of this by use of a timeline. So let's say I have my timeline. Yeah. So this is the beginning of the year. So this is the beginning, and then this is the end of the year. And then here, took out loan. My took is wrong. So yeah, we take out a loan, took out loan. Let's say this loan is for 500,000. And then the interest rate is 12% at 12%. Then let's say the date here is 1 March, 1st March, right? And then let's say our year starts in Jan and then ends in December, right? So our financial period is normally 12 months. And then here on the 1st of March, we took out a loan. So if you see here, we did not have this loan for the entire 12 months. It means that this interest that we are going to calculate here must be a portion. So we'll say 500,000 multiply by the 12% interest, and then multiply by, we'll say March, April, May, June, July, August, September, October, November, December. So we'll multiply by 10 over 12. And then I think our interest will be around about 50. Yeah, it should be 50,000. So our interest here will be 50,000. So you see, if you do not include this 10 over 12 year, the interest that you got would have been 60,000, which is incorrect in this situation that we have here, right? So interest is just simply straightforward like that. The only thing that you always have to remember, was the interest calculated based on simple interest or was it calculated on compound interest? Because if we are dealing with a simple interest, you'd have to calculate it on the original amount and use this formula there. But if we are using compound interest, you calculate it on the balance of the loan and use this formula there. In accounting, I don't think they will require you to use any of these two formulas that will be required in your maths curriculum. The only thing they might require you here to do is just to calculate the interest on a very simple way. They'd give you an amount and a rate with how we just did now. So how would the journals of e-interest look like? So the first one would be we receive a loan, right? So firstly, you'd receive a loan because of you've taken a loan from the bank. So you'd have to debit your bank because of your assets are increasing, and then you'd have to credit a liability because of you have to pay that money back to the bank. The second thing that happened is that this loan that we have taken would attract interest. So we then need to account for the interest on the loan. So the interest on the loan is simple. We are going to debit our interest expense there because of our expenses are increasing and they increase on the debit side. We'll have our interest expense, and then here again we'll go if it's going to be one of the two things. So firstly, we can either have bank. Bank would apply if we had paid cash for this interest. If we did not pay cash for this interest, then we would have, let's write a loan liability there. Loan liability this would increase the liability I have on that loan because of I need to pay more. So let's include our loan liability this side as well. So when we receive the loan, we will recognize that we have a loan liability that needs to go to our balance sheet. And then when we recognize the interest expense, it's either we paid it for cash or we still owe that interest to pay it over. And then the third scenario would when we are making the payments. Payments made. So when we are making the payments now, it means that we need to debit our liability and reduce it because of it is going down. So here we would reduce our loan liability, and then on the credit side we would have our bank because of we are making a payment, right? So interest, dealing with interest is just simple forward like that. You just need to remember it's okay, this is what would happen and which financial statement it would affect. One thing I want to highlight though when it comes to here is that reconciliation of e-balances, because I've seen them ask this a lot when it comes to your financial statements. So your cash flows and your balance sheet, your cash flows and income statement, they like asking you this thing. And then this reconciliation is what would assist us there. So we know that we always have our opening balance, and then we would have our movements. So the types of movements we would have for interest, the reconciliation of e-loan balances would be interest, because interest is what increases this account. And then the second reconciliation would be any payments we've made, because of payments would also reduce this account. If we pay, the account must go down because of we no longer owe, right? Then if we incur interest, the account must go up because of we still have to pay interest, right? So we'd have our opening balance there, and then here would be our closing balance. So one thing I want to emphasize is this payment here that is made here consists of two payments, right? So the first payment is the capital portion. So by the capital portion, we mean the original loan amount taken, right? And then the second thing would be now the interest portion. So by the interest portion, this one is the easiest one. So we have number 2 here, then we would have our interest portion. So if we're looking at that example we did, our capital, so we'd say that if we say 500,000 times 12 multiplied by 10 over 12, that gives us 550,000. So we owe these guys 550,000. 500,000 in this belongs for the capital which we received, and then 50,000 is for the interest. So when payments are made, they will always tell you that this payment includes a capital payment and interest. If it includes that, it means that a part of it belongs to the capital portion, and then part of it, so would have the 50,000 for the interest here, and then here we would have the 500,000, not 550. Sorry, let me fix that. So it will be 500,000 for that capital portion of the interest. So every year when they make payments, so let's say every year there's a payment of 15,000 that is made. So let's say they pay 15,000 a year in relation to this loan, right? So in that 15,000, you'd find that about 10,000 is for the capital, and then 5,000 maybe would be for the interest. So I am saying this because they might give you everything here, and then you might be required to calculate this figure here. So if you are required to calculate this figure here, you need to know that this figure here, if you get 15,000, 10,000 is for capital, 5,000 is for the interest, because it is important for us to know how much is interest. This is the figure that will go to our income statement and your cash flows as well. So I hope that makes sense. Very important, just is this reconciliation and knowing that when you pay, you are paying for that original amount of the loan and the interest that you have incurred on that loan that you have taken. Thank you. See you in the next video.